Okay, thanks for showing up so early in the morning. I'm sure we'll have a few people trickling in, but we might as well get started. Let's start with it. We're going to do 15 minutes for authors, 10 for discussants, and then I'll open it up. We'll open it up to 5 minutes of Q&A, which I'll let the authors handle. No author responses unless someone in the audience asks a question from the discussion that they can respond to. But let's get started. I think our first presenter is Lynn. Lynn's going to present, and we'll go from there. Thank you.
All right. So thank you very much for having the paper in the session. And this is a joint work with Ken and David, and thank God they are both here today. And so the motivation in John Cochrane's AFA presidential address in 2011. So when he talked about the zoo of new anomalies, he asked several key questions. For example, which characteristics really provide independent information about average return? And more importantly, can the cross-section of expected return be parsimoniously described by just a few characteristics or factors? So these are the key questions that we're gonna test in the paper. So our approach is to first categorize anomalies into short horizon versus long horizon. And then we explore what factors are important to explain each group of anomalies. We propose two behavioral factors. Each captures the distinct component of short-term versus long-term mispricing. And then we augment the CAPAN with two behavioral factors. We form this three-factor risk and behavioral composite model. So the goal of this paper is to see whether this three-factor composite model can provide a parsimonious and a better description of the cross-section of expected return. So why behavioral factors? Behavioral theories suggest that there could be return co-movements driven by common mispricing. And for example, in the style investing model of Barbaris and Hirshleifer, we know that investors tend to categorize assets into different styles. And then we allocate funds into, they allocate their capital on the style level instead of individual assets level. So as such, when investors are subject to correlated sentiment shocks, these shocks can cause return co-movement of assets sharing the same style, even when their cash flows are uncorrelated. Alternatively, in the overconfidence model of DHS 2001, and overconfident investors may misvalue certain fundamental economic factors. So all the stocks, all the firms whose cash flows are derived from these factors tend to have return co-movement, incremental return co-movement related with this factor mispricing. So behavioral theories suggest that it could be helpful if we can incorporate behavioral factors into asset pricing models, and we may have a better understanding about the cross-section of expected return. So how do we construct behavioral factors then? Just as Farmer French construct their risk factors based on characteristics that they argue associated with firms' risk exposure, we construct behavioral factors based on characteristics that ex ante are expected to be associated with mispricing. So we propose two behavioral factors. The first one is the long horizon behavioral factor based on security issue and repurchase. And there's a familiar idea that firms tend to issue overvalued equity and buy back undervalued equity. And the story is that managers, market timing, managers have the true information, true value of the managers who know the true value of their firms, they tend to exploit pre-existing mispricing by trading their shares. And of course, this mispricing can come from many possible sources. But how does this financing practice predict future returns? And one explanation is that overconfident investors, they hold stubbornly on their mistaken beliefs. So when they see this equity issue and repurchase activities from managers, they do not update their beliefs adequately. And instead, they wait longer period. They wait for a longer period of evidence to come in, and formally, eventually they get convinced and correct this mispricing. So empirically, we do see that these financing variables can predict returns in the longer horizon, such as 3 to 5 years. So we conjecture that a factor formed on these financing activities should be helpful to capture all sources of mispricing that managers try to exploit. And there is a financing factor in the literature, for example, the one proposed by Hirshleifer and Jiang, and which is based on the firm's external financing events, such as IPO, SEO, debt issues, etc. So in this paper, we propose a modified financing factor based on firms' financing information from annual accounting reports. And basically, we just combine the 1 year net share issuance and the 5-year composite issuance. And we form this financing factor by standard approach, 2x3 sorts on size and external financing, value weighted, and the factor is rebalanced annually every June. And we form a further conjecture that this financing factor is useful to, it mostly captures primary long-term mispricing that corrects beyond 1 year. And we believe that managers are less likely to issue our repurchase to capture, to exploit relatively short-term mispricing for many possible reasons. For example, the underwriting, legal, or disclosure cost of issue repurchase, or in line with the asymmetric information model, if managers indeed do this high-frequency issue or repurchase, investors could get skeptical about them, about whether managers are trading against them. So that's the first financing factor over long horizon. And the second behavior factor we propose is the short horizon factor based on quarterly earnings announcements. So there's a familiar idea about the post-earnings announcement drift. So firms who reporting positive earnings surprises tend to outperform those reporting negative earnings surprises in the subsequent 6 to 9 months. So one leading explanation is investor limited attention. The idea is that investors tend to underreact to the implication in current earnings surprises about future earnings. So we conjecture that the factor based on earnings surprises should be helpful to capture short horizon mispricing driven by investors' underreaction to quarterly earnings announcements. And of course, we acknowledge that quarterly earnings announcements is not the only source that the investors underreact to over shorter horizon. However, it still provides a good window because it arrives regularly for all the firms and is highly relevant to firms' fundamental values. So we built this PEED factor and based on earnings surprises, which are measured by cumulative abnormal return during the 3-day window around the announcement date. And the factor is formed by 2x3 sorts on size and CAR and value-weighted rebalanced monthly because this factor is designed to capture highly transient mispricing. So now we have these two behavioral factors, PEED and FIN, and we augment the campaign with PEED and FIN. We have this 3-factor composite model. And we do want to emphasize the parsimony feature of our model. And comparing to other models in the literature, it is built on fewer factors and fewer economic characteristics to form these factors. So the main key job of this paper is to compare the composite model. How does our composite model works in terms of explaining returns relative to other models in the literature? And in light of Bareilles and Schenken 2016, and this suggests that when comparing asset pricing models, it's important to compare their ability to price all assets, not only both test assets and also traded factors. So we then form these two sorts of tests. In pricing traded factors, we look at how behavioral factors price other factors, vice versa. And in pricing test assets, we examine how well does this composite model explain portfolio returns associated by various return anomalies. So first comparing our PEED and FIN with other factors, and we compare with traditional factors and a set of recent prominent factors. And we want to, our PEED and FIN factor are built on 3 economic characteristics: financing, earnings surprise, and also size. So even though we don't have a size factor in the model, but we do count size as a separate characteristics because we use it in the 2-way sort method to form the factor. And similarly, we also count size as a separate characteristics for other factors as long as they use the same methodology. And we compare PEED and FIN with traditional factors and recent factors such as the 4 factors in Novimark's model formed on 5 characteristics. Here we include industry because their factors are industry adjusted. We also compare with the 5 factors in Pharma Fringe 5 model, 5-factor model based on 4 characteristics, and Hou-Xue-Zhang's 4-factor model based on 3 characteristics, and Stambaugh-Yuan's model based on 12 characteristics. And this table shows that the FIN factor in the bottom 2 row here, the FIN factor has the highest monthly factor premium on average. And the PEED factor has a fairly high monthly premium as well, 65 basis points per month. And it also has the highest Sharpe ratio, 0.35 among all the factors. In terms of correlation, we find that the financing, the FIN factor, is highly correlated with value, and the 2 investment factors, CMA and IVA, and also extremely strongly correlated with the management factor, 0.8 correlation. This is probably because the management factor is a composite factor formed on several characteristics, including financing. And the PEED factor is strongly correlated with the momentum and the performance factor of Stambaugh and Yuan. And ex-post tangency portfolio, and if we focus on the sub-panel that are highlighted in bold, we see that if we gradually add in recent factors into our BF3, that's the composite model, it does not, so additional recent factors from the literature does not substantially increase the Sharpe ratio of the ex-post tangency portfolio. It increased from 0.52 to 0.56. At the bottom of the table, if I throw in all the factors, we see that the ex-post tangency portfolio put 26% weight on the Pete factor, 0 weight on the Fin factor, 20% weight on the management factor, because the management factor is composite on several characteristics, including financing. And they also put 23 and 17% weight on the PMU factor, that's the profitability factor of the Nobel model, and the investment factor of Houxiu-Zhang's model. So it seems like that the PMU, the profit of Nobel model, and the investment of Houxiu-Zhang's model indeed seem to have some incremental information relative to our P and the financing factor. Pricing traded factors, the main method is we run time series regression of monthly returns of one factor and on monthly returns of a set of other factors. And we focus on the regression intercept or alpha. So if one factor can be fully captured by other factors, and we expect the alpha to be close to 0. And I have to skip this table. So in summary, we find that none of these factors price Pete, and most factors do not price Fin except Nobel and Stambaugh Yuan's factors. Vice versa, Pete and Fin, two factors together, can price many other factors, including standard and recent investment profitability factors, but do not price size, PMU profitability, and investment of Houxiu-Zhang. In pricing test assets, we examine a set of 34 anomalies closely following Houxiu-Zhang's paper, and we further classify them into short horizon versus long horizon. And these are the list of anomalies. And so the main test is we compare how well does the composite model explain this set of 34 anomalies. No. So we compare our composite model with the traditional factor models and the recent prominent factor models, these four. And the methodology is factor regression. We run time series regression of long-short factor returns on each factor model, and we examine the regression intercept or alpha. And we explore these 5 common performance measures from the literature. That's the key result of the paper. That's the summary of scorecard of different factor models. We see that for the short horizon anomalies, the BF3 model, the composite model, can fully capture all of these anomalies. Okay, that's a sharp edge, winning edge against other competing models. Well, over the long horizon, our BF3 factor model perform similarly well as the Nobel and the Stambaugh Yuan's model, but outperform Pharma Fringe 5 and the Houxiu-Zhang's model. Overall, grouping all the anomalies together, and the BF3 model, the composite model, misses 3 out of 34 anomalies, which is better than each of the recent competing models, Pharma Fringe 5, etc., and they miss 18, 5, 6, or 7 anomalies respectively. So for the limited time, I don't have time to go over each of the other performance measures, but overall, we find that BF3 composite model performs better in terms of explaining the 34 anomalies we examine, especially over the short horizon. Here, we do want to emphasize the parsimonial feature again. So we believe that it is not correct, it's not right to determine which one is the winner model. It's not right to fully look at the model performance or model fit. And if this was the right way, then we can imagine that a factor model with 1 million factors will easily be the winner, but no one will take seriously about a factor model with 1 million factors. So the balance, there is a balance between model fit and parsimony, and we think the great criteria is to have a model that better price cross-sectional return at the same time is also parsimonious, using less factors and characteristics. We also run some cross-sectional tests to see whether behavior factor beta predict returns. And we also run a set of robustness tests related to limits to arbitrage to extend the idea that these 2 factors indeed capture common mispricing. And at last, I want to spend my final minutes on some very new, very preliminary test, parsimonious test, not yet in the paper yet. And we want to formally test the idea that the less parsimonious model more subject to overfitting problem. And in terms of describing the parsimonious criteria, we think that both the number of factors and the number of economic characteristics matters for parsimony. And we create two parsimony index. And the first index is the negative of the sum of characteristics used to build each factor. And higher, it's bounded above by 0, so higher value means more parsimonious. The second index, PI2, is the sum of factors plus the sum of characteristics. So the difference here is that this index does not penalize a model for using the same characteristics multiple times for several factors, such as size. And again, it's bounded above by 0, so higher value means more parsimony. And we examine these 4 model fit measures. So our main method is we run this regression. We regress the model fit or model performance measures on each model's parsimony index value. And note that the higher, for example, if using number of significant alpha as the model fit measure, the higher value means worse performance, worse model fit. So we observe this upward sloping relation between model fit and the parsimony. That means for a less parsimonious model on the left-hand side, less parsimonious model has better fit, and the more parsimonious model has worse fit. So indeed, we do see some overfitting problem for factor models. And we also want to focus on the residual. So if we look at the residual of the BF3 model, we see that it has the most negative residual. That means after corrected or adjusted for parsimony, and the BF3 model gives the best performance. And the results are similar, very similar for if we're using other performance measures, metrics such as HG distance, etc. To conclude, in this paper, we propose 2 behavioral factors, each one constructed on 2 firm characteristics, and each capture the distinct component of long-term versus short-term mispricing, and each one dominate in explaining one group of anomalies, long horizon versus short horizon. And based on that, we propose a 3-factor risk and behavioral composite model by augments the CAPM with 2 behavioral factors. And this model is more parsimonious, using less factors and less behaviorally, theoretically motivated economic characteristics to build the model. However, it provides generally better description of the cross-section of expected return. So overall, the broader message is that it is useful to consider both traditional risk factors and the behavioral factors in understanding the cross-section of expected return. Okay, thank you very much.
Discussant is Rob Stambaugh.
Well, thanks very much for the opportunity to discuss this very interesting paper. As Lynn explained, there are basically 2 arguments that are advanced here in constructing factors. First is that limited attention, the mispricing created by that will be sort of correcting in short horizons, whereas overconfidence creates mispricing that doesn't get corrected till longer horizons. And then these ideas are applied to develop 2 behavioral factors. Both are formed by sorting on stock characteristics. The first sorts on a PEAD characteristic, which is a CAR, return around earnings announcements. The second sorts on an equity issuance measure. They then get 2 factor models with and without a market index. I think the BF3 model with a market index is the primary model we're considering here. And as they show the desirable properties of this model is that it uses few characteristics, it prices other factors, and it prices anomalies. So the issues I'd like to focus on here, first of all, the anomaly playing field that is used for this comparison. Second, why no size factor in the model. And then I'm going to come to this issue of parsimony, and finally talk about the desirability or lack thereof of combining characteristics to form factors. So first of all, the anomaly playing field they look at here are 34 anomalies, which are largely coincide with 35 anomalies that Ho Chui and Zhang found were not significant with respect to no factors in a model. But I would point out that when you take those same 73 anomalies and ask how many are significant with respect to, say, the CAPM or Fama French, you get a higher number. And of course, we wouldn't know how many are significant a priori with respect to some other factor model. So let me just suggest an alternative playing field that you could cultivate out of those 73 anomalies. For each of these factors, in fact, I'm going to compare their model to our 4-factor mispricing model. For each of these non-market, non-size factors. Pick the 5 anomalies out of the 73 that are most highly correlated with the factor, throw those out. When you do that for the set of these 4 factors, you get 58 remaining anomalies. And on that remaining set, you can see that our M4 model produces an average absolute alpha 18 basis points a month versus 28 for theirs. Smaller absolute average T, much bigger GRSP value, 10% versus 0.23%. It also, by the way, explains more variance of returns on these anomalies. If we take these 58 anomalies, break them into short and long horizons using their same method, on the short horizon anomalies, it's pretty much a tie. We have smaller alphas on average and a bigger GRSP value, but slightly, I think 5 versus 4, significant at 5%. Among the long horizon anomalies, the M4 model, I think, does considerably better. Much smaller average alphas and T statistics, bigger GRSP value, and gets 32 out of the 42 having smaller alphas. Second issue, why no size factor in the model? The model is described as a composite risk and behavioral composite model. There's a lot of evidence that there's a lot of size-related co-movement in stock. So if one purpose of a factor model is to use it for risk management and explaining risk, you would think a size factor should be in here. And I would note that size is not at all priced by this BF3 model. Either the Fama-French SMB or the version that Yuan and I formed that tries to eliminate mispriced stocks from the calculation. Both are in very significant alphas of about 0.5% or so a month, with a T statistic of 3 or more. So I think that putting a size factor in the model would be an interesting thing to do. Let me show you what happens when you do that on another set of anomalies that Yuan and Jean-Philippe and I used in a 2012 paper, and a number of papers have used subsequently. This is the set of 11 very prominent anomalies from the anomaly literature. And here I've just added our size factor to BF3. I'm calling it BF4, taking that liberty. You can see what happens, actually. Sort of twice as many anomalies out of the 11. 6 versus 3 becomes significant at 5%. The GRSP value for the 10 of those 11 anomalies that have complete data over their sample period goes from 5% down to 0.36%. And a size factor does explain a non-trivially larger amount of variance of these anomaly returns. So I would advise just adding a size factor to the model, I think. By the way, when you look at these 11 anomalies individually, when you do that, I might note that even the issuance anomalies in that set, net stock issues and composite equity issues, turn out not to be priced by this BF3 model, which has an issuance factor in it. They construct their issuance factor a bit differently, but it seems like the issuance is not terribly robust to being priced by this model, and you can see a number of other of the anomalies become significant when you put a size factor in the model. So let me come to this issue of parsimony, which the paper stresses. They argue that measuring parsimony by counting the number of factors doesn't make a lot of sense, because after all, there's always a single factor model. They would argue that instead you want to count how many characteristics you use to construct factors. And I'd like to take issue with this. I mean, this concept of parsimony, it's sort of simple in concept, right? I mean, it's how many degrees of freedom are consumed in constructing the model. I think this is a very elusive idea to apply in practice due to the fact that, as the profession sort of mines data and looks for factors, that you consume degrees of freedom. And I think simply counting up how many characteristics are used in the ultimate set of factors that are put in a model can be rather misleading. This PEAD factor is doing a lot of work here. It's got a huge Sharpe ratio. The 1.21, I think, is the annualized Sharpe ratio. It's the biggest Sharpe ratio I've ever seen for a factor in a factor model. I guess the question I raise here is this really the clear choice of a factor a priori for capturing limited attention? In particular, you know, you're sorting here on a characteristic that is the reaction. In fact, you're basically buying stocks that reacted strongly, have a high CAR. You would think if you were looking a priori for a limited attention factor, you would look at the news rather than the reaction, right? So if you're going to be going long stuff that's sort of underreacted, you would think you'd want to buy the stuff where the news was big, but the reaction was small, whereas instead you're buying stuff where the reaction was big. And you know, the authors are honest about the fact that they looked at another sort of SUE factor that would look at the news, and they found it didn't work as well. There's a footnote in the paper to that effect. So I do worry whether this PEAD factor with this huge Sharpe ratio, to what extent that's using up degrees of freedom that aren't really being counted, along with all the other sort of mining that goes on in profession-wide here. You know, if you ask how parsimonious, for example, is combining, say, n characteristics with a weight 1 over n versus choosing one characteristic out of a set of n, you know, is combining more characteristics, say, with equal weights, a good or bad thing? Let me give you a simple way of thinking about this. Suppose you take a given characteristic in a stock and sort of decompose it cross-sectionally into some relation to true alpha, some relation to in-sample alpha, and then some component related to neither. And you form a new factor by averaging this characteristic across, averaging n characteristics across stocks and sorting on that. Now, if gamma is 0 here, if there's no relation to true alpha, but there's a relation to in-sample alpha hat, and you start averaging a bunch of characteristics with that property, then as Novi Marx has pointed out in a recent paper, you get a spurious factor that's going to work really well in sample because you're basically diversifying away the noise that keeps it from getting alpha hat even better. Right? On the other hand, if gamma is positive, if there's some relation to true alpha, and the theta here is 0, if there's no relation to the alpha hat in sample, then by combining characteristics, you get a really good fact because you're diversifying away noise that would otherwise obscure information about true alpha. So I think ultimately the question is here, are we more in a gamma world or are we more in a theta world? Right? And let me just close by providing sort of one piece of evidence that comes from a recent paper I have with Zhou-Meng Liu and Yu Yuan, looking at 5 other non-US countries. We'll look at these same 11 anomalies. Now, we can only do 9 of the 11 because the Discussant O-score anomalies, we just didn't have the bankruptcy data needed to refit those models in these countries. But what we find is these anomalies exhibit patterns in these other countries very, very similar. You know, country by country, anomaly by anomaly, we could show you results that almost always conform to the US. We even constructed tests where we assume that all the results in the US are due to data mining. In other words, if you assume that the true alphas on these things in the US are 0, condition on that, and then compute the estimated alphas in the other 5 countries. That's the second set of columns here. You still find that these anomalies are generally highly significant. When you construct an overall composite measure by averaging these anomaly rankings across anomalies, you can see you get something like an 81 basis point per month alpha with a t-stat of 12, even assuming that the anomalies in the US are truly 0. Okay? And with that amount of time, again, thanks.
We might have time for one or 2 questions. Anybody have a question?
So,
Yes.
so if I can respond.
No, I want to wait if there's questions.
Oh, I'm sorry.
Respond.
Never mind.
Any questions? Sorry, I'm adopting John Carson. All right, I'll give you 1 minute to respond.
Thanks so much. So I think one of the first really great discussion. Thanks so much, Rob. One of the key issues is whether our notion of parsimony means anything. So this mere counting of characteristics or number of factors that's really getting at some lack of parsimony in the factor model. And Lynn's the latest slides there, which is very preliminary, in which Rob, you maybe you didn't get a chance to see until now, is basically doing a graph, making use of factors from various different action models in the literature, and then finding that the less parsimonious by this kind of measure, the better the fit. So it does seem like you're throwing more factors in the literature, or you're throwing a greater number of characteristics used from factors in the literature, that you're systematically getting well fit. So that seems at least suggestive that there is indeed an overfitting problem, though I highly agree with you that from your slide that the anomalies you showed do seem to be robust in terms of predicting characteristics. If I can just react to only one other of the points. Okay, thank you. Okay, so adding the size factor, and maybe we should, it does go against our parsimony notion, especially adding a size factor which is not just long-short based on size, but long-short based on using a very large number of characteristics. So yes, we can get very different results if you add a size factor of that sort, but you shouldn't.
Okay, thank you. So, Tarik, you're up.
Hi, thanks Toby for the invitation. Thanks Shimon for what I'm sure is going to be a valuable discussion, and everyone for attending. This paper is related to the literature on investor attention, which has used proxies for attention like Google search volume, Bloomberg usage, and related that to market outcomes like volume, volatility, and returns. It's also related to the textual analysis literature, which has looked at properties of news like the sentiment, number of negative words, or the complexity, and related that to market outcomes. And usually there's also an investor attention story embedded into why there's this mechanism. A challenge, though, is that a lot of these things are correlated potentially with unobserved variables. For example, the type of event may determine both the textual features of the news, the amount of attention the news receives, and the market outcomes. And even attributes of news like sentiment and complexity are highly correlated. So it's difficult to understand whether people are underreacting to like negative words, if negative words predict things, or are they underreacting to the fact that negative news is also more complex. So I'm going to try to use a couple of unique settings. I'll introduce some settings that allow me to think more causally about which attributes, first, do attributes even matter for attention? And then can I isolate complexity from other attributes like sentiment? And what I do is I show that these attributes do seem to matter for attention, and then I relate this to market outcomes. This title, the aspect of news that I focus on are titles or headlines, so that's what I'm going to be analyzing here, and you'll see why. Because I have this interesting field experiment with randomization, which is going to allow me to do this. So in order to see whether features of news matter for attention, I'm going to need some sort of measure of attention to news, or in this case titles, which is usually hard to get. And then I need variation in that news that's unrelated to or where I hold the context fixed. So I can isolate the event, and I look at variation in text within the same sort of event. And the solution here is something called title testing, which is done more and more these days online. And Seeking Alpha is someone who began doing this in January 2016. They're a leading crowdsourced investment research community. They're very active, lots of millions of investors. They write hundreds of stock reports. They're also quite sophisticated on average. And this is what a stock report might look like. Swaraj, he has a CFA, so I can see something about the sophistication of the authors. And he writes a report on a farm tire company, and these are some summary bullets. Below is the article, and below that are the comments. And so one reason why people, I think, participate on Seeking Alpha is, one, you might build reputation if you have good ideas, but really there are not that many ways you can get quick feedback on your thesis, and the fact that thousands of people read and then comment is actually incredibly useful. So going back to the experiment, here authors propose a couple of titles for the same report, and then email alerts are sent to all the investors who are interested in that firm's news. So if you're interested in Tesla, you sign up for alerts, you'll get an email on some news about Tesla, but the title you see is randomly assigned to you. After 30 minutes, Seeking Alpha chooses a title that gets the most attention as the title to publish. And here's some examples of the email alerts. So you can see that across the emails, these are 3 emails, you'd get one with random assignment. The bold is the title, and that's what varies. But everything else, the author, the timestamp, and the URL you have to click to see the article are all the same. So the only thing that varies is the title. You only get one title in an email. So let's think about complexity. Here I'm going to look at just length because of the time constraint, and it's going to be number of characters and say the headline. And then I'm going to regress something simple, the attention that title received, and then I'm going to regress that on the length of that title. But this is, again, within a stock report, so I have this fixed effect, alpha j, which is I compare within the report these variations in length and attention, which is unique to this setting. So if I don't use any fixed effects and I just do correlation, I see a positive relationship between length and attention. And when I put in this fixed effect, I see a strong, highly significant negative relationship between length and attention. The t-stat is 30, and you can see the within R squared is 6%, which suggests that this variable is an important explanatory variable. And I like to relate the magnitude. So the magnitude is, these are all standardized, but a standard deviation change is about 11% of a change in attention. And that's related to a standard deviation increase in the VIX, which in seeking alpha leads to 8% more attention. So this variable seems to have a reasonably important effect on attention. If you plot this chart, if you plot that regression, the 0 here is within an article, so that's the average title for that article, and a 0 for the views is the average views for that article. You see a very linear relationship. This is in levels. It's a bin scatter plot. And this you can see also in regression form. If I just look at titles that are 1 character difference, that's column 1, or within 2 characters different, 3, 4, I immediately pick up that same coefficient. So it's not, so one concern is that longer titles may just be more informative and people don't read longer titles because they get the point. Well, I can do a couple of things. One, I'm narrowing the volume difference of information and I still get the effect. I can also look at the text. So I can look at titles that are very similar. So the top example, Malakindrukt is a one-hit wonder. Is Malakindrukt a one-hit wonder? Exactly the same content. And when I look at the first column where I look at only the ones that have high word overlap and compare it to the ones with low word overlap, I get exactly the same result. So this does not seem, using these quick tests, to be something related to differences in information. I can even do a pixel test where I look at the fact that eyes have less pixel length than M's, and this is going to be something that shows up more when you have more characters or longer titles. And so if I look at column 3, I look at only titles that are longer than 45 characters, I'm getting almost the same relationship. So perhaps there's some visual complexity or heuristic that people use, but they seem to focus on shorter titles more than they focus on longer titles, regardless of the information. So if I throw up a bunch of titles, usually people will tell me that they focus on the Navistar report's 4th quarter results first before they focus on any of the other titles. And it's not because they read the titles and decided to read the short one, they just read the short one first. And the question in this sort of paper is, does this matter maybe for more things like how people read the news on companies? Quickly on sentiment, just one slide. So I look at the negative, I evaluate the number of positive words and negative words in titles. Net sentiment is positive minus negative. And it looks like there's a negative relationship. So positive titles get less attention, negative titles get more attention. And what's interesting is if I control for complexity with the length of the title, you see that they're correlated and the result of sentiment goes down about 20%. So if you do papers that use sentiment, you should also correlate or control for complexity. But still, a challenge remains is that it could still be that positive titles and longer titles are more informative, or longer titles may be more boring. So one way to get around those comments is I'll introduce an instrument. But first, before I do that actually, I ask whether less sophisticated investors are more sensitive to these attributes. So does their attention matter, or is it more affected by length and sentiment? And what I do to measure that is I look at the audience in terms of the people who comment on the reports, and I see, do you have an MBA or a CFA, like Swaraj had a CFA? Are you self-declared financial professional? And if you are, if there are more of those people, you see that the effect of title length, it's interacted, is lower. So it looks like more sophisticated people are less affected, but they still are affected. And these people also tend to write longer comments and more numerical comments, and if you write longer comments and more numerical comments, the effect also seems to be lower. But if you're a retail investor and you only know about Tesla, like large popular companies, you see that the effect seems to be stronger. So there does seem to be a relationship with sophistication. Also, if you are the type of person who does click on longer titles, you're also more likely to read the full report. So I have a measure of, do you read to the end of the report? So the report is exactly the same. So what this is picking up is some sort of selection effect. Okay, so to do the instrument, what I use is the fact, so it's really, really hard, right? Titles are all endogenous. So I need something that's exogenous to the title, and what I use is the legal name of the firm. I think that's one of the only things one can really do to answer this question. But so you can see with credit cards, you have Visa and American Express. That name difference is going to lead to differences in title length that are persistent through time. So what I'm going to exploit is that in the cross-section. And it's going to be, importantly, unrelated to the new information, like the earnings surprise or whatever the news is about, because it's chosen in the past. First stage is very strong. One concern, though, that I do acknowledge in the paper is that name length is correlated with size. It's not obvious how it should have been, but it's negatively correlated. So longer or bigger firms tend to have slightly shorter titles or names. But once I control for the size of the firm and I take the residual, so I do like a regression and I take a residual, then it looks like the residual is unrelated to firm characteristics, and there are a lot of characteristics to explore. And when I put these in regressions later, it doesn't really affect the magnitude. And so what do I find? Well, first stage, again, is strong. That's column 1. And then the last column is the IV. What you can see in bold is that I'm getting a coefficient on the instrumented title length that's similar to what I got with OLS. So it suggests that there's something about a pure complexity effect, not an information story, that's driving this result. And it's a nice way to test the instrument because I have measures of attention. And I have the other result, the OLS result is, I can use the article fixed effect, which is a powerful control in itself. So if we look at the market, now the question is, does any of this that I find in Seeking Alpha explain or matter beyond Seeking Alpha? And the challenge is that earnings announcement press releases are, again, endogenous, so I exploit the fact that I have this instrument, which seems to work in the Seeking Alpha context, and that's going to give me variation in the cross-section of firms that's unrelated to the earnings surprise. And what I find is that this is all instrumented, but if I look at the length of titles, it's negatively related to turnover on announcement, trade on the NASDAQ, the high versus the low of the day. That's the intraday range, the volatility, and return. And I'll talk about the returns. And these are all abnormal, so I'm taking out market sensitivities. And if you look at the return result, I interact that with positive surprise, whether the earnings surprise is greater than 0 or not. And you can see for negative news, which would just be the first row, you see that it's 0.118, which is a positive number. It suggests that prices didn't fall as much for the negative news, i.e. there might be an underreaction. And then if you look at the positive news and you add the two coefficients, you get something that might look like the price doesn't go up as much for positive news. There might be an underreaction. The last two columns, I do it in levels, so everything else was standardized. But in levels, you see the same sort of pattern in levels on time t. But then if I look at t plus 1 to t plus 90, you see something that looks like a reversal. So it's something that looks like this underreaction reverses in the next 3 months. And now what's nice about that is that if you have an instrument that's not informative and causing some maybe shock to attention, it shouldn't last forever. So the fact that it kind of reverses is somewhat comforting regarding the instrument. Okay, now I look at whether these sensitivities to complexity, if it does matter, do they vary over time or with the context? So in Seeking Alpha, I showed you that when the VIX is higher, more people read news. So if I look at the VIX and I interact it with the length of the title, I find that, yes, on high VIX days, the turnover effect is lower, and the other ones too. So it seems like when maybe the anticipated benefits of focusing on the market and reading news are higher, people are more willing to pay that cost or more willing to engage, and they're less affected by this visual complexity aversion. Also on Fridays, people are less willing to read news in Seeking Alpha. So if I go back to the earnings announcements, most of these Fridays are actually just slow days, so I look at days with not a lot of earnings announcements, and on slow days, you see a bigger effect, and on busy days, you see a weaker effect. So again, it may be that when there's a lot going on in the market, it's more interesting, there's more anticipated benefits to reading news, you're more willing to engage with complexity. Interestingly, on Seeking Alpha, people are much more willing to read in the morning than in the afternoon. So if I look at an interaction with length in the afternoon, I find that, yes, for earnings announcements that come out in the afternoon, this effect is stronger than for announcements in the morning. And then I can look at the sophistication. So I showed that if you have an MBA in Seeking Alpha, you're less sensitive. Well, here I don't have that information, but I have 13F ownership. And it looks like if you have greater 13F ownership, you're less sensitive to things like complexity. So less of the underreaction. And then also if you have analyst coverage, you're also less sensitive. And what's interesting is if you have analyst coverage, if you have a bigger absolute earnings surprise, so something that's a bigger shock to the market, then you see less of a reaction. which is perhaps because greater media coverage reduces the effect or the importance of title characteristics on whether you pay attention in news. So that's the takeaways. What I explored is, do textual attributes of titles actually matter for attention? And then I used the instrument to isolate complexity from other things like sentiment, and I show complexity may matter in a pure sense. And then take that instrument to the earnings announcements and look at whether that matters for market reactions, and it does. And it also seems to matter for academics, and that's where I'll stop. So longer abstract titles, or longer titles for your papers are correlated with less abstract views and also less downloads. So something to keep in mind. Thank you.
Discussant is Shimon Kogan, who's stepping in for Marina Niessner. So thank you.
Thank you. Oops. As you can see, I'm not a PC user. Okay. Oops. So thanks for including me in the session. As you could notice, I'm not Marina Niessner, but she's here more than in spirit, in that she helped prepare some of the materials for the discussion. So the paper is really, the idea behind the paper is really intuitive and simple, and I can explain that, I think, with 3 slides. If people have limited attention, then reading long titles is taxing, and so that's kind of how should we think about, we should think about complexity. And the prediction is that shorter titles would lead to more response to information being released. So the good news is that it's a really simple and nice idea. The problem, as Tarik explained, is that it's really hard to find field experiments that will control for everything that we would be concerned about. And so this paper has not just one such experiment, but 2 experiments, right? One is the literal randomization introduced by seeking alpha, which I think is really cool. And the other one is the simplicity randomization through firm name length. So overall, it's a great paper. I really enjoyed reading it. It was really thoughtful. It was deep, and it was very convincing. So all of this is good news. And by the way, it shows a bunch of effects on readership, on volume turnover, on returns, etc. So if those are the good news, what are the bad news? Well, the bad news are for me, right? So typically, a discussant kind of goes to the obvious suspects of a paper, quibbling over endogeneity, or the importance of the question, or maybe the economic magnitude of the effect. And I don't have these simple lines of attack. So what am I going to do? Well, I'm going to quibble still a little bit. But more importantly, what I want to do is I want to show you some new results that are really focused on external validity. And then finally, and through them, actually, I'm going to suggest potentially an alternative instrument that can pick up the same effect that can be applied very broadly. So on the quibble side, so let's get rid of the typical discussant role real quick. What can go wrong? It sounds really perfect, right? Because seeking alpha literally randomizes who they send title length to. What can go wrong with, so you know, I've done experiments, right? Doing an experiment, a lab experiment, what you want to do is you want to make sure that you control for everything else except for the treatment. And here it's very close, but it's not perfect. In what way? Well, you cannot really vary title length only, right? And so there are other attributes of the title that change when you change its length. What am I concerned about in particular? Well, so the way it works, right, the author suggests the primary title, and then seeking alpha says, oh, can you provide us with another title? Imagine that the shortest title is also the best title. In some abstract way, I'll come back to this. And the longer title is worse. Then, of course, we would attribute what the paper attributes as a response to complexity or length is really is response to the quality of the title. Now, this can be addressed. Here's a simple way the paper can address that, and I was surprised that there was not there were a lot of results in the paper. I was surprised that there wasn't one summary statistic table or something that I could look at to get at that. What you can do is you can show that there are consistent results when you separate regressions where the alternative title is longer versus one that is shorter, right? If it is, then I think that'd be, it's not going to be perfect, but it'd be a nice way of addressing that. I also, like, on that topic, I think that the seeking alpha experiment is really, really cool. And I would try and exploit other features of the of title that, aside from basically counting the number of words or the number of characters, right? I mean, there's a huge literature on readability. Does readability matter for this? There's a complexity in kind of deeper sense, not just the length of the title matter. And finally, it could be really cool to look at cross-language differences, right? Because Seeking Alpha is a platform that has users from all over the world, and it knows a lot about its users, including the IP address where they access the article from, right? So you can at a very simple level, you can just look at native English speakers versus not, but you can also look at people whose mother tongue is naturally longer versus shorter than English, right? So Hebrew is an example of a language that the average sentence length is shorter than English. Would the response of these different audiences be different? Now, that aside, I'm a believer in the overall message of the paper. And I'll give you a few examples for why I'm a believer. For one thing is because some people that are a lot smarter than I am understand this. So this is the title, this is literally a novel, a fiction book that was released this week by a marketing faculty, who's a friend as well. And you can see that the title length, so people in marketing understand marketing, the title length of this is literally one character, right? That is a picture. To be honest, on the side, if you cannot read Hebrew, it says that the longer version of the title is X in the middle. In Hebrew, it's actually only 2 words. So people in marketing understand this idea. And almost all of us are subject to it. So you stole a little bit of what I was about to do, because we thought about similar things. So I was curious, with all the endogeneity issues aside, I was curious whether that affects readership in SRN papers. So I downloaded data, or Marina helped me scrap the data for the top 5,000 download the paper in Financial Economic Network. This is the distribution of length. It's about 8-9 word title. And you can see that basically one standard deviation lower title length leads to about 6% increase in readership. It's not huge, but then again, hopefully we're talking about the most sophisticated of audiences. I was trying to do some it's very simple cloud, looking at where this model gets very low residuals versus high. You can see some stuff, but I don't want to spend too much time on this. The second external validity that I want to talk about is linking it to a paper that Marina and I have with Toby, a new paper looking at fake news in financial markets, where essentially, in a very short version of it, what we're doing is we're using NLP to assign a probability that if an article on Seeking Alpha and other platforms like Seeking Alpha is fake. And then we validate this measure through a set of different sets, including a set of what's called promotional articles. So this is basically articles that after the fact were exposed to be paid for indirectly or directly by the company. So this is an example of a promotional article. You can see that it kind of very much looks like a pump and dump, a modern version of a pump and dump scheme. And this is how well we do in being able to pick those articles that ex post we know were fake. And you can see that we're doing, our measure is doing really, really well. So given that I had access to similar data, and given that those two are potentially related, I went back and we calculated the article title length of all Seeking Alpha articles in our sample. And I do find that there's a very strong negative relationship between length and probability of being fake. So people that write fake news understand the need to draw attention. How strong is really, really strong, right? I mean, stronger than what the paper reports. One standard deviation longer titles are associated with about 37% less likely to be fake. What I also noticed in going through this, and this is the alternative measure, is that article length is very, very persistent, even if you include firm fixed effects. So that suggests that there is some attribute that is exogenous to what we care about that we can utilize, right? So if you look at, what I mean by that, if I regress the length of the title on lagged average length, the beta is going to be about 0.8, and the R square is huge. So we can use lag author title length as an instrument. And when I do that, I find that the results that I report here are much, much stronger. And I also find that the return response to fake news is stronger for shorter titles using this instrument. Just to leave on a few open questions, I think that this setting can allow us to say a lot more about how limited attention is allocated, because the data set knows not just because we can actually talk about the extended versus intensive margin, right? I mean, do people allocate attention when you shock them with title length across media, like financial media readership, or do they allocate overall more or less? And that could be really cool, because by chance, some users would have received very short titles on a given day or very long titles on a given day through that randomization. And hopefully, through that, we can also say something about the extent to which this behavior is rational versus behavioral. I think that, again, we can explore other effects that title has on readers. And finally, maybe in a broader way, this can be related to kind of how should we think about the market for attention in a world that's dominated by tweets. So in summary, it's an excellent paper, and it has a short title. So other things equal, it's going to have a more meaningful impact. I'll stop here. Thank you.
Tarik, if you want to, we're being recorded, so if you could sit up there and handle the microphone. We might have time for one question. If you have a question, though, please use the mic, which I know automatically raises the cost of asking the question. So, any takers? If you want 30 seconds to respond, you can. If not, we'll move on. But please.
Sure. No, it's true that the alternative titles could be different, and I do, and they are actually different, so they tend to be slightly longer, slightly more positive. What I have done is put in fixed effects for whether you were the original or alternate title in all the regressions. And I think also if I do the instrument, that should give me variation, because I'm looking then across companies rather than within an author. That should help me make sure that it's not just that the alternative title is worse or something, but it definitely is different from the original title. And I think you gave a lot of great points to think about for future work, so I really appreciate it, Shimon. Thank you.
All right, we'll move on to the next paper. David, take it away.
Okay, thank you very much, Toby, for the opportunity to present this paper. That's joint work with Jean-Philippe Bouchaud, Philipp Krueger, and Augustin Landier. And what we do in this paper is a very simple exercise. We try to offer a simple theory of the profitability anomaly, and we try to test it on data. So the motivation of this work is really the profitability anomaly, or the quality anomaly, or the so it has several names, but essentially the idea that past firm profits forecast future returns. Okay, so essentially, so here it's just an illustration of this anomaly, where we sort firm by their past cash flow to total assets, and then we construct a long-short portfolio and calculate the cumulative return since the early 1990s. As you can see, this is an anomaly that generates like consistent, I mean, this is not our finding, it's known in the literature. It's an anomaly that generates like very stable returns with a very crude risk control that we do here. We have a Sharpe ratio of 1.2, so which is pretty high. So it doesn't have like very obvious historical crash risk like momentum, and it is valid in all regions, as Rob actually showed in his slides. So the the other advantage, I mean, or the other impressive feature of this anomaly is that it is highly scalable. So you can put a lot of money at work on this anomaly because the signal is very slow moving. A firm is profitable, it's going to be profitable for a long time, so it's really slow moving. So it allows you to build up positions very slowly and unwind them very slowly and still reap the return of the anomaly as it comes and goes. So, so it's really, and it's not a small cap anomaly too. So it's essentially, like by all standards, a big anomaly. It's a very big anomaly. So it begs the question as to why it occurs. Is it mispricing or risk? And here in this paper, we try to offer a theory that's based on underreaction. Okay? So first, what we'll do, we're going to present a very simple pricing model with expectations, with a form of underreaction that's been promoted in the macro literature that's called the sticky expectation model. And in this model, I will show you that first the profitability anomaly holds. That's why the theory was built for. But also we're going to derive ancillary predictions that we're going to test in the cross-section of stocks. Okay. Then I'm going to do the testing. And the testing itself is simple, but what's critical is to compute kind of the extent to which there is underreaction, and that's where I'm going to spend some time. Okay, so first model, then test. So let's start with the model. So the model is extremely simple. It's bare bone. Everything is in one slide. So you have infinitely lived agents that are risk neutral, that have a discount rate R, and they price a stock which generates future profits. And obviously, the price of the stock is equal to the sum of future profits discounted by R. And of course, because those profits are uncertain, you need to forecast them. So as of day t, you try to forecast all p t plus k, all profits in the future. And in most models, in rational models, that capital F up there is the capital E, is the mathematical expectation, is the rational expectation. In this model, expectations are not going to be rational, they're going to be sticky. So we are following a formulation that's been put forward in various papers by Nishenko and Quabion. So that formulation is very simple because it embeds rational expectation as a particular case. Okay, so there is. So essentially, when you forecast future profits, your forecast is going to be a mixture of rational forecast, 1 minus lambda times the rational forecast. Okay, so if lambda is equal to 0, your forecast is fully rational, and lambda times your previous forecast of the same profits. Okay, so lambda measures the extent to which you stick to your previous forecast. If lambda is equal to 1, you never update. Okay, so this lambda thing is going to be important throughout the talk. That's the thing I'm gonna focus on. So typically lambda, so in the macro literature, typically lambda is considered as being positive, as in expectation being sticky. But you can also think of a world where lambda can be negative in the sense that people overreact to recent information. Okay, so it's a model that kind of embeds kind of overreaction and underreaction in a neat and very tractable way. And then we need to impose some structure on profits, whereby profits can be forecast by a signal that investors are assumed to observe. Okay, and this signal is itself persistent over time. Okay, so that the persistence of the signal kind of captures the fact that profits are persistent, or if you have a signal about profits today, it's also a signal about profits tomorrow, etc. So it's a very simple but quite generic formulation of the information structure of the firm. And that's all. That's all there is in the model. There's nothing else. Okay. So then we work out the forecast as using the formula for forecast and the structure on profits, and we find the following two predictions. Prediction one is the one that that's not using at all return. So I'm not using the price formulation. It's just direct effect of the formulation of forecasts and the profit structure. Is that past profits predict future forecast errors. Okay, so forecast errors shouldn't be forecastable if lambda was equal to 0. If forecasts were purely rational, okay? But because forecasts are sticky, then current profit high current profit predict higher future pessimism by forecasters. Okay, so the forecast will be below the actual realization systematically if current profits are high. That's because people underreact to current information. Okay, so that's a very simple prediction to test. If you have like investor forecasts, so we're going to use analyst forecast. If you have forecast, you can regress analyst forecast on past profits and see whether there is a positive correlation. The second prediction is more directly related to returns themselves. So here we can derive the covariance between future returns and current profits, and it turns out that that covariance is positive. So in this model, in this current profit predict future returns as in the profitability anomaly. Okay, so that's kind of what we want. The intuition is very simple. The intuition is simply that the signal, the innovations on the signal are imperfectly incorporated in investors' beliefs. Okay, and as a result, people underreact, and so they price the stock at a lower price than what it is worth. What's interesting here in this model and what we can test, bring to the data in a more subtle way, is first that that mistake is bigger if you're stickier, which is kind of obvious, but also that that mistake is bigger if profits are more persistent. Okay, so if the signal has more persistence, which is exactly the same as the persistence of profits here, so if the signal has more persistence, people make a big mistake by not taking into account the increase in innovation that is going to have a very durable impact on future profits, basically. So that's a bigger mistake to make if the signal is persistent. So basically, the two testable implications that we're going to test are first, that the profitability anomaly should be higher for stocks that have a higher lambda, that are traded by stickier investors. Okay, so I'm going to have to spend time talking about how we measure lambda at the stock level, but that's kind of one of the predictions. And the second prediction is that the profitability anomaly should be stronger among stocks that have more persistent profits. Okay, so these are two predictions that are direct predictions of the model and that have to hold for our theory to make any sense. What I will mention very briefly is that in fact, when you work the model, basically these predictions, the prediction on future or forecast error and the prediction on future returns, okay, are predictions that actually also apply to alternative anomalies. Anomaly one being the earnings momentum anomaly, so sorting stocks by change in profits is going to forecast future returns, okay? And all these things work. So past increase in profit should forecast future forecast errors. Past increase in profit should forecast future returns more if lambda is higher or more if profits are more profitable or more persistent. And it's the same for the classic momentum anomaly too, okay? So this is a kind of a theory that also kind of speaks to these two anomalies. Okay. So what is the first prediction that we test? It's the prediction that says that high current profit forecasts future pessimism among investors. So essentially that if profits are high today, then tomorrow profits are more likely to be above expectations. So the data that we are using, and here we're making a big assumption, is that analysts' actual EPS is that analysts have forecasts that are the same as investors. So we're going to take the Ibis data set. We start in 1989 and not in the mid-80s because our anomaly, the anomaly that we look at is the net cash flow over total assets anomaly, and this is not available before the late 80s. So it's essentially 25 years of data on analyst forecasts, okay, and realization. What's nice also with Ibis is that we've got, okay, no, I get back to that. So the first prediction is just summarized in this table. So we basically regress the forecast error on cash flow on the cash flow anomaly, and measure of profit in the first column. Okay, so you see a very strong coefficient, very statistically very strongly significant with a t-stat of 6. And then, as I told you, what we can do also is regress the forecast error on other measures of good innovation on the signal. So typically, past increase in returns or past increase in profits. Okay, and as you can see, this is also extremely significant. Okay, so this is like pervasive evidence that there is underreaction coming up here. Okay, so then what we need to do is to measure stickiness in order to test our core prediction that the profitability anomaly should be stronger for stickier firms. So in order to measure lambda at the firm level, what we do is that we use a methodology that has been developed before, which relies on the fact that the sticky expectation model leads to the following equation right here. What does this equation tell you? This equation tells you, so it's equivalent, it's just an alternative formulation of exactly the same equation. So what does this equation tell you? It tells you that when there is an upward revision on the forecast of future profits, if people are sticky, then on average, people are going to be pessimistic. Or put differently, if the upward revision forecasts pessimism, then it means that not all information was incorporated in the upward revision of the profits. And as a result, this is evidence of underreaction, of stickiness here. So the coefficient that you get by running the regression of forecast error on forecast revision is just lambda over 1 minus lambda. So you can directly retrieve lambda. You can run this regression at the firm level and obtain 1 lambda per firm. And you would get a distribution of lambda that is skewed to the, I mean, I don't know which direction it is skewed, but at least there are more positive lambdas than negative lambdas. Okay, so 2/3 of the lambdas are positive, which means that for 2/3 of the firms, analysts behave as if they are sticky, underreacting, and for 1/3 of the firm, lambda is negative, which means that analysts tend to overestimate, overweight, on average, current, recent information. They tend to, basically, forecast revision tend to predict optimism instead of pessimism. But that's just for 1/3 of the people. So on average, the lambda is positive. People are underreacting. So essentially then, in the paper we show that firms that are followed by more sticky analysts tend to be volatile firms, tend to be firms with a lot of disagreement among analysts, tend to be smaller firms. So that's kind of something that you would expect in the complexity kind of way of thinking. We could try to correlate with the length of the title, for instance, or the length of the name of the firm. And then what we do is simply 2 double sorts. One double sort by profitability signal, and then by lambda. So that's what I'm showing here. So Q1, Q5, it's quintiles of past profitability. So in the last column, what you have is the alpha of profitability by tercile of lambda, by tercile of stickiness. Okay, so T3 is the tercile of the stickiest firm, T1 is the tercile of the least sticky firm, and then in the bottom 0.51 right there, in the bottom line, bottom column, this is the result of the double sort. So typically, what it means is simply that high profitability firms are more likely to forecast higher returns when they are followed by sticky analysts. So then we do the same by sorting by profit persistence. Okay, so this is what we do in this last table, and we find the same kind of result, which is that the profitability anomaly seems to work better for firms that have more persistent profits. And then we do the same with past change in profits and past change in prices, past returns, and we still have the same kind of prediction working. So what we propose here is a simple calibratable model where investors have non-Bayesian expectation, and the key parameter lambda can be estimated using a panel of forecasts. So the ideal forecast the ideal data would have forecast by investors, which we don't have, unfortunately. And the model delivers a series of testable predictions. Past profits predict forecast errors, profitability anomaly bigger for firms that have large stickiness or profit persistence. And all these also hold for 2 other anomalies, earnings momentum and price momentum. Thank you very much.
The discussant is Andrea Frazzini.
All right, thank you very much for having me discuss this paper. Okay, let me give you a little bit of background. So what do we know? We do know that companies that are safe and profitable, and also that they're growing those profits, tend to have higher average returns. Practitioner calls the phenomenon quality. You can hear it, profitability, quality. I'm going to use the 2 terms sort of interchangeably. You could do this in gross profits, margin, cash flows, and ROE, ROA. There's lots of measures that you could use. We also know that sell-side analysts' estimates don't appear to be really consistent with rational expectation. There's all sorts of biases that have been documented in the empirical literature. The walk down to beatable by lots of sort of accountants, a disproportionate amount of sort of firms beat consensus by about 1 cent, much more than should be explained by randomness. The frequency of which firms have been beating consensus has been increasing. There's many others. I'll show you another couple in a minute. So this paper tries to do two things. Asking the question, are analyst forecast errors, are they predictable in a way that it's consistent with a model of sticky expectation? And can we link that predictability to the return of a high-quality company, the profitability premium? So what do? They write down a model of sticky expectation and generate testable prediction that you can take to the data. In particular, they predict that analysts should underestimate profits where profits are high, and then they link earnings to prices with a simple asset pricing model under risk neutrality, and then test hypotheses, the high persistence, either in the analyst's belief or in the underlying data generating process or in the profit itself, should predict higher return of a long-short spread portfolio that is long high quality and short low quality. They use Ibis detailed data and CompuStat data from essentially the 1990s to present. They focus on 3,000 largest stock, essentially the Russell 3000. They generate what they call fresh 1, 2, and 3 years out forecasts that are issued right out of earning announcements. So there's no sort of revision on the walk down and things like that. They have two evidence. Evidence on forecast, that is past forecast revision predict future forecast errors, and in particular past profits predict future forecast errors. That's consistent with their model. And then some evidence on stock returns, where they show the long-short portfolio of quality, the return of a long-short portfolio, there's long high quality and short low quality. It's higher either for firms that are followed by slower to adapt analysts or from firms that have more persistent cash flows and earnings. Okay, so let me give you some general comments. I really enjoyed reading this paper. It's a good paper, and underreaction to earnings is a very plausible hypothesis, and linking to a model of inertia allows you to generate very clean testable prediction. Some of them do require expectation data, but others do not. That allows you for extensive out-of-sample tests in the US and outside, and even in time period that don't have actually expectations. So what are my issues? Issue number one is the returns of quality portfolios are actually not the most puzzling, are one of the most puzzling empirical irregularities out there, not because of the size of the returns, but in fact because of the risk characteristics of those stocks. I'll tell you in a minute exactly sort of what I mean. And the paper is sort of silent about that. And so this paper addresses what might be causing the mispricing, but it's silent of the lack of correction. Why is it that we don't see these prices correcting? So I find the evidence interesting. I just don't think it's a complete picture. I'm still left, like I don't know the full picture about the profitability anomaly. And then the empirical analysis, I think, needs some work. I get some, but not all of the results in the paper. I'll show you the difference, and I'll tell you exactly what it is. So what is my data? I'm going to use Ibis APS consensus, the full sample from 1970s to present, and CompuStat CRISP data, again, the full sample from the 1950s to present, all stocks. I don't throw away sort of anything. So first, let me give you some comments about the model. So this paper is testing a mispricing explanation. So what are the ingredients of any mispricing? But first one, you need an initial distortion, behavioral finance 101, and then you need some limits to Arbitrage to prevent me and other people in this room to try to drive prices all the way to zero. Okay? So this paper tests one, but it's really silent on two. They do acknowledge this. They say, well, our prediction will carry on in a model where you have some arbitrage errors that have some limits to Arbitrage. But I will argue that two is really the bigger puzzle here. So first of all, the return of a profitable company has been known for a while. There is a bunch of accounting papers that have shown this since the mid-60s. This is a widely known effect. For some reason, so in asset pricing, we decided to discover this a few years ago, but this has been around for a very long time. Practitioners, both fundamental investors or quant, use this extensively, at least, again, since the mid-60s. Benjamin Grant, both in the original Graham and Dodd and in recent edition, have actually this specific prediction. I have a quote in there from a paper with the session chairs and others. You have to cite the session chairs every time you discuss. Warren Buffett uses this for quants. Just take my word for it. There's many in the rooms. You can ask them. Everyone uses some version of profitability cash flow measure. This is not something sort of new. So what I mentioned, the largest puzzle is really not the returns of this effect, because there are bigger effects. Rob was talking about the PED before. There's many other things that have sort of magnitude returns that are bigger, but it's the risk. That is, no matter how you look at it, whether or not you look at it from a fundamental perspective or from an asset pricing perspective, profitable companies don't look riskier. In fact, they look safer. So what do I mean? They're less levered. They're less exposed to macroeconomic fluctuation, a lower amount of credit, sort of a credit risk and earnings risk. do better in recession. They exhibit tail behavior, have lower betas, regular beta, downside betas, and others, have lower HML loading. They command higher prices. They have lower SMB loadings. They are big companies, and arbitrage portfolios that take advantage of that buy a very low turnover because profits are persistent. That's sort of the whole point of these papers, and buy very liquid company. So any mispricing explanation needs to have some limits to arbitrage that are so strong to overcome all of these benefits, and then it's just not obvious. So again, what I mean is we just really don't have the full picture because you guys picked an anomaly where sort of the risk explanation really goes the other way. This thing they're really, really sort of safe. Okay, so now let me give you some comments of empirical result. First comment is the limited sample. You guys use data from 1990 to present, focus on 3,000 stocks. Data to test model is kind of like water in the desert. You can't throw it away and not tell us why. Ibis data starts in the mid-70s. It covers a larger cross-sections. Accounting data starts in the 50s. Again, you don't need some expectation data for all of your tests, but you should use it all. You can't throw it away and not tell us why. You have to have a very good ex-ante reason of why. So suggestion is you should use all available data in the main test. I'll give you some example. You should use the same time period for the expectations and asset pricing data, and then probably expand the asset pricing evidence. So the first assumption is that what analysts do is what investors actually do. So how crazy are analysts' expectations? My favorite evidence is target prices. When you look at target prices of analysts, you actually get to read exactly the expected return of that particular stock. You evaluate that, you get the expected return on the market. This picture shows you the Ibis consensus expected return on the aggregate US equity market. You can see, first of all, that the unconditional average is twice as high. Analysts think market returns are about 20% per year, and they have some crazy wild variations that just don't look very rational. I don't have time to go into this, but currently the expectation is about 40% return over the next year. Seems sort of a little crazy. All right, so let me show you the first set of results, which are the inner forecasts. So these are Feynman back regression, where on the left-hand side you have forecast errors, and on the right-hand side you have other forecast revision on past profits. The table at the top shows you the log forecast revision predicts future forecast error. The table at the bottom, again, this is with my data, the table at the bottom shows you that past profitability predicts future forecast error. That's consistent with what you have in the model, right off the model. That is, analysts systematically underestimate earnings of more profitable stocks. Am I surprising? Well, this evidence is consistent with evidence by Asnes and Fresini et al. That is, we looked at the same evidence, but instead of looking at earnings, we look at target prices. And this picture shows you essentially the same evidence. Those are quality sorted portfolio from junk stocks to the left to high quality stocks to the right. The top line shows you the expected return from target prices. The bottom shows you the actual realized return. So you can see that the expected return, again, is always higher than the realized, but then you can see that the pattern goes the other way. Analysts systematically underestimate future prices of high-quality stocks. You guys link prices to profit, so it's the same thing, underestimate future profit. So this is the good news. So far, so good. Now let me give you the bad news. So here's my asset pricing test. I took the full sample, and I'm focusing on the prediction that you can test without the actual analyst data, just because it is easier. Full sample of CRIS stocks, 1950s to now. I estimate a firm level persistent, running another regression on gross profits over assets, on lagged gross profits over assets. I require at least 10 years worth of data. I do this in expanding, so with no look-ahead bias. Double sort, you first sort of persistence, and secondly, you sort on profitability. The left-hand side shows you, or that table shows you the unconditional effect. That's the profitability effect. The right-hand side shows you the double sort. Those are monthly in percent. Maybe it's hard to see in the table. I can show you with a picture. So the top side shows you essentially the quality effect in my sample. I do this with full look-ahead bias, like looking at persistence over the full sample, and with expanding and rolling. The bottom shows you the return of the long-short portfolio sorted on persistence, and essentially I don't get your result. That is, in the paper, you see a monotonic relation. The firms that are more persistent, the prediction is they should have higher profits from going long-short, profitable and unprofitable. I don't see sort of a lot of variation, no matter whether you do it expanding or whether you do it sort of in a full sample. So now there are several differences between what I'm doing and what's in the paper. First is the time period. I use the full sample from the 50s to now, or you can use from the mid-60s to now if you want to follow French convention. I use the full cross-section. This is 6,000 versus 3,000 stocks. I have expanded regression with no look-ahead bias. The paper uses full look-ahead bias regression. I use value-weighted versus equally weighted. And then I use a different measure of profit. I use gross profits, a la Novi Marx. The paper uses cash flows. However, it's not clear ex ante why my choices are any ex ante any different than the other choices. So all I'm saying is I'd like to see the empirical analysis expanded. But I think you should start with a broad set of results, all stocks, all data, and multiple profitability measures, because in your theory, it's silent about EPS versus cash flows versus GPOA or others. You shouldn't pick the one that has the more restrictive sample. You should show it all the other sample. And in particular, you can look at out-of-sample tests. So for example, there's a whole section in the paper with simulation evidence about the impact to look at head bias. That's totally unnecessary because you throw away almost half of the data. So you can just estimate your model on that half of the data and then use that to look at persistence on your 3,000 stocks or your 1990s to now. So overall, this is a very nice paper. The evidence on forecast error is interesting. It does point to a mispricing explanation. You do need to show the analyst expectation do really matter. I showed you, you're really assuming that the investors are following those crazy expected return expectation, that it's a very strong assumption. I'd like to see more evidence on the asset pricing on a broader sample. And as I mentioned, if we are going to go with a mispricing explanation for quality, then we're going to need a better understanding of what are the limits to arbitrage. This is a little quote that somebody sort of told me recently that sort of reflects the fact that we really don't know, that we think there is some underreaction to profit, and that I understand, but why is it that these very safe sort of arbitrage portfolios don't sort of push the prices all the way down is still sort of a big puzzle. And the last thing is cite the accountants. This thing, again, mid-60s, there is hundreds of, I was emailing Scott Richardson to get a few more quotes. He sent me about 100 the quotes. I put like 5 of them in there, at least put at least 5 or 6 in there. The accountants are great guys. Hey, with that, let me just stop. Thank you.
The AFA asked me to, in this session, honor our most recent Nobel laureate in economics, Dick Thaler, who's here today, this morning, so thanks. And I'm going to invite Dick and Kent Daniel to come up here. Kent and I are going to say a few words about Dick's work. We thought this would be a good session, given the title, Behavioral Finance at Anomalies, to talk a bit about Dick's work, and then offer, if Dick wants to say a few words at the end, I'll offer that as well. So Kent, Dick, if you don't mind coming up here. First, and before we do that, I want to thank the discussants and the presenters, particularly the discussants, so thank you. But I hope you'll stick around for a bit while we talk about Dick. So.
All right, so I'm just going to talk a little bit about kind of my interactions with Dick over the years. So I guess I really got to know him well when he joined the faculty at the University of Chicago, where I was a junior faculty member. But it's funny, in preparing to thinking about what to talk about here, I was forced to go back and read Misbehaving, Dick's recent book. It was awful. No, it's it's a wonderful book. And in fact, it reminded me why I like Dick so much. It's, for those of you who haven't read it, it's a joy to read. It's just so much fun. And it made me think back to the first time I met Dick, which was when I was a PhD student at UCLA in 1990, when I guess I must have been 12 years old. And so I was a PhD student. I was kind of nervous meeting with Thaler, both because, he was, even by that time, a pretty prominent guy, and also a bunch of people on the faculty told me he was crazy. So, but it turned out it was after 15 minutes, we were having so much, at least I was having so much fun. I don't know if Dick was. He had so many insights into the profession, into how people behaved, and it was fantastic. Thinking back on the other things I remember about Dick, I remember one time I was driving with Dick and my wife in the car, and we were going from Hyde Park, where the University of Chicago is, up to where we all lived, which was the Lincoln Park area, roughly there. And I was at the time, I was moving, I was leaving Chicago, and I had 3 offers. I had one on the West Coast, one in Chicago, and one on the East Coast. And Dick was asking about this, and my wife said, "What should Kent do?" And I remember Dick's response was, "Well, I have no idea. That's a really hard question, but I can tell you what he will do." And it turned out he was right. We ended up staying in Chicago. Another memory that I still think about all the time is I was traveling with a PhD student from Kellogg, and we were going to an NBER conference. And Dick had gotten a car, and we had a driver coming. It was a long way from the airport to the conference. And Dick said, would you guys like to ride with me to the conference? And I said, well, we can't. We have a car. And I remember Dick looking at me and saying, that is the worst example of the sunk cost fallacy I have ever seen. And of course, he was right. So let me just talk a little bit. I've been reading this book over the last month that I found absolutely fascinating. And in fact, I think it has a lot of insights for why Dick has been so successful as a scholar and has changed our field in ways that really no one else has. So this is a book called Creativity, Flow in the Psychology of Discovery and Invention. Okay, and it's by a guy named Mihai I'm going to get this completely wrong, Csikszentmihalyi. And he was actually, he's a psychologist. He was at one point head of the Department of Psychology at the University of Chicago. And the question that he is addressing in this book, it's based on a lot of academic work that he's done on what breeds creativity. And he looks at both the individual characteristics that breed creativity and kind of what needs to be in the pond, what needs to be the environment that results in somebody producing something creative, i.e. something that really changes society. So the individual characteristics matter. That's an obvious finding. Interestingly, one of the key things that he finds is, we have this impression somehow, both in the artistic realm and in the scientific realm, of these lone geniuses, of these people who sit in their offices and produce great work. And the key finding is that's not the way the world works. To be creative, you really need to be very, very social. Okay, and this is something that Dick is a very social guy, for those of you who know him. He likes to be around people. He's obviously very thoughtful. He's thinking all the time, which is something that you really start to realize only when you get to know him, because he always claims he's very lazy. In some ways, maybe, but he's also more observant than just about anybody I've ever met. Now, the other thing that is in this book that I find absolutely fascinating is kind of all the things that you need in a group to kind of foment this creativity. So basically, you need a critical mass of people. You need a set of memes, a set of kind of rules that guide the field. And kind of what creativity does is it changes these memes. So when Dick started the field, I mean, for those of you who are younger than I am, and younger than Dick is, which is not saying much, it's hard to imagine how few people were doing behavioral finance at the time. Dick was basically it. I mean, Bob Shiller had done some really interesting work in the AER, but it's the 81 paper, but he didn't interpret it in a particularly behavioral way. He just saw that demonstrated that there were some very peculiar patterns going on. And Dick was the first one to really bring this idea that maybe individual behavior really mattered, and maybe it could potentially affect asset prices. The paradigm at the time, if you go back to, like, for example, the Friedman 1953 essay on the methodology of positive economics, really spells out why it is you shouldn't consider individual behavior. And it was an interesting argument, but the evidence was starting to become stronger and stronger that these sorts of models were not going to be able to explain the patterns that we saw in prices, in returns. Okay, so Dick really came along, and he did, I would argue, three things that really completely changed our field, that enabled us to have sessions like this at the AEA, to have so much of the field now devoted to behavioral studies. So first off, he started writing the set of anomalies articles for the JEP, which were just incredibly influential. Now everybody knows, not everybody, most people in our field know the content of these articles, but again, at the time, this was completely new to everyone. The other thing that he did, he realized, I think, early on, that you really needed to train a set of young people in the field, with the idea that, for the most part, I guess with the exception of Rob, none of the old guys have really changed that much. Rob's become a great behavioral colleague. So you needed to educate a set of new scholars in what is behavioral finance, what are behavioral ideas, what are the Kahneman-Tversky ideas, and how do you incorporate them into your research. So he started the behavioral finance and economics summer schools, and he started the NBER behavioral group with Schiller. And this really, you know, for me as somebody who was kind of coming into the field at this time, this was just such a great thing because it really gave you a community, kind of let us think about in a very rigorous way how we should be doing behavioral finance, how we should be incorporating these ideas into our research. So let me just close with two things. So just a couple questions. First off, is Dick a nice guy? Okay, so this is a question that gets asked a lot. Not everybody you talk to thinks so, okay? So why is this? Because
Do you have names?
it'll cost you. So I think what Dick does, one of his characteristics which has really helped us a lot, is Dick, if you ever make a mistake, Dick is going to immediately point it out to you. And I know this because I make lots of mistakes. I mentioned the sunk cost fallacy thing earlier, but certainly in your research, Dick, if you do something dumb, Dick will tell you, that is so dumb. And not everybody takes this that well. Lots of people, by the way, take it very well and really appreciate this. The last thing, I mentioned this earlier, but Dick has helped to promulgate this idea that he's inherently really, really lazy. Again, if you look at his output, I'm not sure that's really a credible statement. The number of books, the number of articles, the amount he's done for the profession. But one aspect where maybe you could argue this is one of the characteristics about Dick is if you look at the way he works, he seems to only work on stuff that's fun. Dick has a tremendous amount of joy when he's working. When you talk with him, you see this all the time. And I think it's really helpful to look at this because it's very easy in this profession. You know, we've got wonderful jobs, but it's very easy to get stuck doing something and to just be miserable about it. I often find myself doing this with certain kinds of work, certain kinds of administrative responsibilities, and Dick somehow always seems happy. And this is a really good lesson. It's not that all of our work is always going to be pleasant, but you can make it that way. And Dick seems to have done this and seems to have really filled the field of behavioral finance. It makes it a really fun place to work. And I think that makes us all more productive. Let me stop there.
Yeah, watch it.
Yeah, no kidding.
So thank you, Kent. I'm going to be. Yeah. I've got got a couple of slides here. Okay, so let's see if this pulls up here. This is. Oops. Okay. So this is why we're here. Actually, I got this picture from one of my spies who was in Stockholm. Actually, I would have loved to have been there myself, but I wasn't invited. So, but anyway, obviously, Dick had a good time. Let me start off by just talking a bit about some of the work and allude to some of the things that Kent said. I mean, obviously, people have read about the description and know his work very well. It's, you can think of it as integrating psychology into economics, and I'm going to focus on some of the finance aspects. But if you sort of grouped, and there's a ton of his work, as Kent alluded to, the idea that he's lazy is not credible at all. Cognitive limitations, self-control, social preferences have all influenced a lot of his work, and it spans a number of different models and effects that he's famous for, most notably mental accounting and the endowment effect, the planner-doer model about myopic action versus farsighted planning, and then concerns for fairness and how those might deviate or seem at odds at times with economic rational decision-making. And these things have been applied in a variety of contexts. So obviously economics and finance where we're here, but he's had huge impacts in law and economics, marketing, policy, and one of my favorites, sports. And I'll come back to that in a second. So some academic highlights, obviously from the general economics and financial economics realm, but also, in sports economics, he's got this great paper on the NFL draft that I now finally get to teach. So at Chicago, I never got to teach this because he taught it. It's always the best lecture now in my sports class at Yale, and it still doesn't compare to how Dick gives that. But he was also, many people don't know this, he was one of the first to review an early copy of Moneyball, Michael Lewis's famous book that talked about all this stuff. A great, very interesting article, actually, from an academic economic perspective. But I want to talk specifically about his contributions to finance, behavioral finance. Dick really pioneered the field and fought for it, as Kent mentioned, particularly in the 80s and 90s when he pretty much was the only person pushing this agenda and really working on it. And if you just think about how mainstream behavioral finance is now today, just as an example, I did a quick count. It's one of the more popular and fruitful areas of research, but today, 2008, if you combine the AFA and AEA sessions, there are 10 sessions with behavioral in the title, including this session. And it also includes, there's a behavioral corporate finance, a behavioral macro, these are titles of the sessions, and behavioral real estate. I'm not sure what that is, but it'd be interesting to see. And by the way, it would have been 12 if I had included, there's a session on bounded rationality and another one on morality and economics where 100% of the papers I would consider behavioral, but I didn't even count those. So I think it's pretty clear he's succeeded. And that doesn't include all the many behavioral papers that are populated in the other sessions that don't have behavioral titles. So clearly that battle was fought, won, and continues to grow. Now, in terms of what are those finance contributions, here are some of my favorites. So first of all, the whole idea behind behavioral economics is how psychology might affect economic decision-making. And in particular, I think of Dick's work as having shown there's an influence of psychology on asset prices. Okay? In particular, one of my favorite papers is the original DeBont and Thaler paper, the classic overreaction study. I teach this to my PhD students as here was really I view it as one of the first behavioral finance papers, if not the first, where it took an alternative hypothesis, took it to the data, right? And a very interesting paper and one that spawned a whole field that I'll get to in a second. I also, there's the Bernardzi and Thaler paper on myopic loss aversion as an explanation for some of the high premia. We've struggled with how large equity premia are in the data with all these, fiddling around with all these different models, and sometimes a very simple sort of behavior model, very consistent with a lot of the evidence from Kahneman and Tversky seems to capture a lot of that. And then, of course, his work on mental accounting has inspired all kinds of offshoots, like the disposition effect, and other things that we now take for granted as things that investors seem to suffer from and follow. In addition, limits of arbitrage have also played a big role in his work. Again, one of my favorite papers is Lamont and Thaler, the three-com-pom, carve-outs. I love teaching that paper, and it's just one of the best examples. I think it's the best example I can think of deviations from the law of one price. So clean and nice, and just a really nice set of examples where the joint hypothesis problem is not an issue. And then, of course, he's had enormous impact on savings and retirement, which spans both economics and finance. I think of it more as a finance problem, and that's just not academically, but enormous practical impact as well in saving rates and everything else. And then, finally, in terms of his contributions, then I'm going to say a few personal anecdotes. I also give Dick a lot of credit for, again, Kent alluded to it with his articles on anomalies, but giving us a framework to think about anomalies. I mean, without that, what you're really doing is just claiming the residual. Well, this model doesn't explain this fact. It becomes a residual. Going back to the DeMont and Thaler paper, there was another paradigm, another model you could write down, whether it's an overreaction model or an underreaction model or various behavior type models that give you some guidance for how to look at the data and interpret the data. And I think that was enormously impactful, not just in academia, but I can tell you even in industry as well. Those stories resonate, and not only are they believable, I think they're largely true in many, many applications. So I've got let me say a few personal things about Dick. In grad school, Dick is famous for having noticed that economists don't behave the way that their models say they should, right? And he made a career out of that. The thing is, though, is that Dick suffers from the same affliction. His career has been built on, all the biases, errors, and mental mistakes that many people make and are affected by. He tends to rarely fall for these himself. And I can tell you that being his colleague at the University of Chicago for 17 years, one of the most rational colleagues I've ever interacted with. This comes to hiring decisions, promotion decisions, strategic issues with the school, very clear cut. There is, however, one exception to his rational behavior, and that's when it comes to wine consumption. And this is, he has a very mental accounting of wine, which I've benefited from, which is he thinks of the price of the wine that we're drinking as what he paid for it as opposed to its market value. And thankfully, that means he opens bottles he probably shouldn't be opening. So I've been the beneficiary of that. But actually, I think he secretly knows that this is the case. It's just he wants to drink the wine, and it's a great story. However, he doesn't do this when he purchases wine. One of my favorite articles, and Dick knows this, was he was written up in Wine Spectator applying his behavioral theories to wine auctions, avoiding the winner's curse, doing all these other things. So again, very, very insightful and very practical as well. So if I just sum up sort of Dick's work as well as my personal interactions, he's innovative, he's clear, he's got uncommon wisdom, and he's always helpful. This extended to not only academic questions that I would ask him, but even to the way we would play tennis. He invented a game called equilibrium tennis, which adjusts for who's having a good or bad day or who might be better in terms of skill so that the match is much more enjoyable. It's actually quite creative. So it's sort of like handicapping in tennis, but a very nice idea. And if I'm gonna turn the mic over to him in just a second, but he's also one of the other things that I think he deserves a lot of credit for is the clarity of his ideas. If you've ever seen him present, he's not only funny, but he's also incredibly clear. And one example of this was I had the pleasure of interviewing Dick at a practitioner conference about behavioral finance. And Dick was one of the keynote speakers, and the other keynote speaker was Billy Beane, the famous general manager of the A's and the main character in the Moneyball book. And I remember that Billy Beane was as excited to meet Dick Thaler as I was to meet Billy Beane. So, and we had a very good time that night. So just to conclude here, one final thing I want to say is I really do thank Dick for his incredible mentorship. So Kent mentioned how he furthered the field in behavioral finance. He's also like that as a colleague. I was lucky enough to be a junior faculty member at Chicago under his tutelage, and I learned a lot there from going back and forth between Dick and Jean Fama's office and realizing that 98% of the time they agree, actually. And you learn a lot from that. And because of that, I have an appreciation for behavioral finance, which I was not primarily trained in. But it's been a privilege to work with him. I'm extremely happy that he was so honored, and I'd like to turn it over to you now, Dick. So congratulations.
So first of all, thanks so much for organizing this. Second, I sound like I'm going to die before the session ends, which might happen if I use the same route that Kent took, but I actually sound a lot worse than I feel, so don't worry too much. I don't have too much to say. One is that it's a great surprise, looking back, that behavioral finance turned out to be the most successful branch of behavioral economics. I published 2 papers in 1985. One was DeBont and Thaler, and the other was my mental accounting paper, which I intentionally published in a marketing journal because I thought behavioral economics, the natural place for it, or one natural place for it, is marketing, because what is marketing if it's not behavioral? But basically, standard price theory leaves all the marketing stuff out. So I published those 2 papers, And if you had asked me to bet which one would have a bigger effect, I would have put all my money on the marketing paper. That has been a complete flop. Not the paper. The paper is the most cited paper in that journal, although every referee rejected it. But behavioral economics has essentially no presence in marketing. I don't know why. There are lots of psychologists, but maybe a handful of people that would call themselves behavioral economists. Finance was the domain where we were pretty sure there was no room for behavioral economics because arbitrage, Frazzini and Moskowitz will get rid of any anomaly that comes along. And so when DeBont, I've had a career of corrupting youth, and DeBont was one of my early corruptees. And he told me he wanted to write a thesis in finance. I said, okay, sure. I don't know anything about that, but we'll try. And that's what led to that 85 paper. And fairly soon after that, well, when we first published that paper, it created an uproar. Every grad student at the University of Chicago was given the assignment of finding DeBont's programming error. And like there was a prize. I think there was a war between Mert students and Jean students as to who was going to find the programming error first. DeBont is super careful. There was no programming error. And so Jean and Ken came to the conclusion that, well, yeah, I guess this is true. And eventually we have a three-factor model as a result of that. Mert's efforts went in a different direction. So why is it that behavioral finance has succeeded? I would say it's two reasons. One is great data. Of all the fields of economics, in finance, we're blessed with the best data, unbelievable data. I was presenting a paper for the first hour over in the convention center on Swedish social security system, and we have the trades of every Swede since 2000, and that you don't get that kind of data in other fields, not to mention daily price data going back to 1926. So great data and very convenient null hypotheses. So if you look at DeBont and Thaler, the null hypothesis was you can't predict the future from the past. And everybody thought that was true. Why did everybody think that was true? I would say part of it is what the psychologists would call confirmation bias, which is people were looking for confirming evidence. And so what were the early tests of market efficiency? It was daily serial correlation in stock prices. And so the null hypothesis was that it was zero. It turns out it wasn't zero, but it wasn't very big. And it wasn't tradable, so victory. So what did DeBont and I do? Well, we just took the longer horizon, that's all. It wasn't a great innovation. Ranked stocks, best to worst, and it was the simplest thing anybody could do. But nobody had ever looked at that before. So the last thing I'll say is why did I insist on corrupting the youth? It's because I don't think I've ever changed anybody's mind. And one exception to that is Richard Posner, who somehow has become a liberal. And you can't give Trump credit for this, because I think the main thing happened was he read Keynes. And, but anyway, I was telling this story to Andre Schleifer and in an email exchange, and he was going to meet with Posner. I said he was the only person I know who's ever changed his mind. And Andre said, "That's not true. I respect you now." Thank you very much.